Our first guest speaker tonight is Christopher Thornberg. Christopher Thornberg is a principal of Beacon Economics. Dr. Thornberg is an expert in the study of regional economies, real estate dynamics, labor markets, and business forecasting. He is one of the people that saw this coming early because he could see no sense to the numbers anymore, making sense for people being able to pay so much for homes, and it turns out he was very right. Prior to launching Beacon, he worked with the UCLA Anderson Forecast, where he regularly authored the outlooks for California. Christopher, glad to have you here. Thank you. Appreciate it. Uh-oh.
There we go. Never mind. I take that back. It works. Good evening, everyone. It's very nice to be here. You know, I have to say up front that when Aaron first contacted me and asked me to do this tonight, I was actually very, very happy to do that. I should say that I also lost a parent to cancer, and so this is an issue for me that's quite close to my heart. And so it's, thank you for being here. So, now with that in mind, I'm of course leading things off, which is not necessarily a good idea. The good idea was that you ate first. For those of you who know, of course, I've been a bear for quite some time, and I'm here to talk a little bit about what's happening to this economy today. You pick up the newspaper, read the news. It's all over the map, right? It's hard to tell what's going on. We know that, for example, unemployment in California is 7.3% last month. That's higher than it was at the peak of the 2001 downturn. However, we had about a 1.7% growth rate in the second quarter of this year. Not too bad. Housing starts continue to plummet, but realistically, they can only go to zero, right? So, we're not too far from that, and it's going to end at some point in time, right? So things that keep things in perspective, right? We know the consumer seems to be tottering. Auto sales are plummeting, but industrial production is doing okay, and exports are booming. So what's going on? Certainly interesting times we live in. There's no doubt about that. And, of course, the big question everybody has on their mind is, which way is the economy going? There's one view out there that, we've seen the worst. Now it's behind us and things are moving forward, the recovery. There's another view out there that says, this isn't a recession, it's never going to be a recession, but we are going to kind of sort of bink along for a year or so. My former employers at UCLA see this view of the world. And then, of course, there's another view, which is that the worst is yet to come. The fact that this thing is going to actually get worse over the course of the next year or so. Now, I know this is going to be shocking, but I tend to be in that last camp, and I'm going to talk a little bit about why tonight. It's funny. I'll tell you, a reporter asked me one time, they said, eventually this is going to end. Because I always keep this in mind. As bad as things get, they will come to an end. Things will get up and running again. No matter how rough it is, the fundamentals of the U.S. economy, a great infrastructure, a hugely educated workforce, the best technology in the world. These are going to come back and they're going to pick the economy up and we're going to move forward again. Always don't lose sight of that long-run situation. But a reporter said to me, well, what are you going to do? When things finally do hit bottom and start coming back, are you actually going to be able to be a bull for once? And I went, well, I'm going to have to see a psychotherapist for a few months, but I may be able to do that, right? So let's talk about three things. I only have 10 minutes up here tonight. I want to talk about housing, I want to talk about the financial markets, and I want to talk about the rest of the economy. Now, oops, that went too far. Can we go back a slide, please? Okay. I got my slides a little backwards here. Pardon me for that. That's what's going on. So let's talk about the housing market for a second. We know prices have come down quite a bit. But, of course, the thing that everybody's been seeing on the horizon is that sales have started to tick up. We're starting to see some liquidity in the market. Is the bottom near? Well, my answer is unfortunately no. Keep in mind that this situation we're in right now is it's not a liquidity crisis. It's not a problem with the mortgage markets. In fact, there's not enough money out there. It's not a problem even so much with the home builders that we have a massive excess supply, because we don't have a massive excess supply. We have some oversupply, but not a massive one. The biggest problem we've had in our housing markets over the course of the last few years is that prices went to levels that were just ridiculous. In a classic case, this would be Los Angeles, and I have to go through this very quickly. In 1999, in Los Angeles, you could buy a house for $199,000. That was actually kind of expensive. If you looked at the money that people who own homes earn, and you asked how much would it cost them to buy that average house, turns out they would use 30 to 35% of their income. And that's expensive, but you know, it's okay. It's a city, it's expensive. Fast forward to 2006. Now that same house in Los Angeles doesn't cost $200,000, it costs $577,000. Now, certainly incomes went up over that same period of time, but if you sit down and do the same calculation, you find out that that same average homeowner buying that same average home would have been using 70% of their income to buy that house. Well, that doesn't make any sense. The biggest problem we have in our housing markets, and what remains in our housing markets, of course, is prices, and prices have yet to fall. Now, of course, prices got that high because of the subprime mortgage market, and we know the chaos there. We don't have to go through it. But I do like a little irony. You know, did everyone remember the Greenspan's froth speech that came out a bunch of years ago? I don't see a bubble, but I see signs of froth. You know, the interesting thing he says is actually later on in that speech. This is a quote. This is right off the Fed website. Home price declines, were they to occur, likely would not have substantial macroeconomic implications. Why is that? It's because nationwide banking and widespread securitization of mortgages make it less likely that financial intermediation would be impaired. Well, of course, we understand now that the problem in our housing markets, the reason prices went up so high, is because, of course, all that crazy money that let people gamble on homes like never before. And now we're seeing the back end of that. We're seeing prices fall, and they continue to fall. In fact, the pace of falling right now is about 30% per year. Okay. And, you know, we have a lot of long ways to go. Sure, we've seen an uptick in sales. There's no doubt about it. But that uptick in sales is not enough to absorb the amount of houses that are going onto the market right now. This is from the first quarter of this year. This is notices of default, data quick numbers, and I'm comparing it to sales. In San Bernardino County in the first quarter of this year, there were 11,000 notices of default. There was 4,000 sales, home sales. In other words, for every home that's being sold, there's another 2 that are going into foreclosure. Don't think this rise in liquidity is the bottom of the market. We have a pretty good ways to go. Now, overall, how far price is going to fall? Well, by my models, it says something about 50% or so. From that measure, we're about 2/3 the way there, maybe halfway there. It depends on what neighbor you happen to be living in, but still a little ways to go. Now, of course, this all tracks through to all these nasty financial losses we've been seeing in those markets, because all of this stuff is translating through to a tremendous amount of losses. We've seen all the mess. It's going to be over $1 trillion, probably $1.5 trillion before it's all said and done. The banks at this point in time have declared about $400 billion. There's a long ways to go there, there's no doubt about it. Fannie and Freddie are still hanging on. I can't figure out why. When you consider that Fannie and Freddie are overexposed to Arizona, Nevada, California, to Florida, why are they overexposed? Because they were trying to keep up. They're overexposed to these markets, prices are plummeting. The kind of loss ratios they're going to be facing on any kind of foreclosed property, regardless of why it happens, is going to be enormous. And of course, when you're leveraged 100 to 1, like Fannie and Freddie are, you don't survive. It's just that simple. And of course, this big housing bill that just passed, well, that doesn't really help anybody. What are the big things in there? Well, they give local governments enough to buy some homes. Sit down and do the calculations. All that money will allow California local governments to buy about 4,000 homes. So what? And of course, you have some money that's bailing out Fannie and Freddie. That's going to be in there, basically going to be renationalized. And of course, the third part of that process is basically allowing banks to refinance certain homeowners. And if they do that, they get mortgage insurance. But of course, the only thing that is a bailout for the bank, because they're going to pick out the worst mortgages and refinance those at 15% less, and let Uncle Sam pick up the bill when the person actually does roll over and the loss ratio is 60%. So again, not a lot of help.